Welcome, everybody. In this session, we're going to explore capital structure decisions, how companies choose between debt, equity, and other sources of financing to fund their investments. We'll also see how these choices impact the value of a firm and its stock. Our foundation will be Chapter 15 for the Financial Management Theory and Practice by Brigham and Earhart. And we're going to start step by step and provide some company evidence along the way. A firm's value is determined by free cash flows and the weighted average cost of capital. Capital structure affects the weighted average cost of capital because equity financing has a cost, R sub S, while debt financing has a cost, R sub D. For example, Apple has used low-cost debt strategically. They issued $14 billion in bonds in 2021 to fund some buybacks, even though it had a large cash reserve, because interest rates at that time were near historic lows. This lowered its WACC and supported a higher valuation. The variables in our discussion are as follows. V is the value of the firm. Free cash flow, we've talked about many times. This is the funding that's available after everything has been paid for in the company. It's money that's left over to pay its investors. Weighted average cost of capital is the average cost of financing. The R's, R sub S and R sub D, are stock and debt costs. WS and WD are the percentages of the firm that are financed with stock and debt. Many times we've talked about some tax cuts, the Tax Cut and Jobs Act in 2017. Just as a reminder, the tax rate, the corporate tax rate, is a flat 21%. Currently, interest divided by EBIT, or the percentage of EBIT that is allowable for interest expense, has to be less than 30%. Now, this is fairly new, 7-8 months worth of activity. So it's kind of difficult for us to talk about exactly what's going to happen because we haven't had enough evidence to show this. But this should cause firms to reduce their debt. What is business risk? It's the uncertainty due to demand, pricing, or input costs. The top 4 items here are really part of the industry, and management cannot really choose the levels. Operating level leverage, though, is a choice managers make when they decide how to produce their products. The greater the capital intensity, the greater the business risk. Airlines are a classic example. Delta's EBIT fell by more than 60% in 2020 because of COVID demand shocks, showing how volatile cash flows discourage heavy debt use. Firms in volatile industries prefer equity-heavy structures to help preserve their flexibility. Business risk comes from operations, while financial risk arises from leverage. Managers choose a level of debt in financing their operations and their investments. Tesla, for example, faced very high business risk during its early years. They are, after all, a very high capital equipment kind of company. Adding debt financing amplified that risk. In 2018, they had a debt equity ratio above 200%. This was worrying investors about default risk. So we're going to look at 2 companies. They are hypothetical companies. They're identical except for the debt level. You can see in firm U, the equity, U being unlevered, is 20,000, but there's only 16,000 in equity for firm L because it has 4,000 in debt. Therefore, because it has debt and there is a cost to debt, we will see that it has lower earnings before taxes. It will then also have lower taxes, obviously, which gives it lower net income. So the only two difference between these two companies is its net income and taxes. So let's look at some of the calculations. Again, both companies have the same operating income, EBIT. Net operating profit after taxes is also identical. Their operating capital is identical. So their return on invested capital, regardless of the amount of debt, is the same. Both companies will earn 9% on their operating capital. What is different, though, is equity. Firm L has less equity. Its net income is less. When you calculate return on equity in this case, what we find is that even though it has less equity, it's turning a higher rate of return. That's because even though there's lower net income, it's distributed over a smaller number of owners. So what is the impact of leverage if earnings before interest and taxes falls? Here we have 1,600 is our EBIT. Here's our interest is the same. Taxes, 320. Net income, obviously, no, that's going to be lower. At this point, though, in return on invested capital, we know that that's going to be the same regardless. But return on equity, in this case, because it's very low, return on equity is equal at this point. For the other one, if it drops even further, the end result is return on invested capital is the same. What is different, though, now is return on equity. Return on equity for the levered firm is even lower. So, again, what this tells us is that leverage magnifies outcomes. So in good times, we're going to have higher earnings per return on equity, but in bad times, we'll probably have much lower return on equity. So Amazon is an example of positive use of leverage. Between 2010 and 2020, they increased its debt more than fivefold, but its return on invested capital consistently exceeded its cost of debt. So this allowed Amazon to expand aggressively into things like logistics and cloud computing, creating huge shareholder value. So if we summarize these tables, look at the outcome. We see that we have declining EBIT. ROIC, again, is declining because of lower EBIT, so it's going to be less. The cost of financing, cost of debt, is the cost, 8% times 1 minus T. So we have the same cost of debt, and what we find is at high levels, the return on equity is greater than the cost of debt. So in this instance, we would be adding value to the firm. But in the far case, if things were really bad, we actually would learn less in return to equity than the cost of financing the debt. So in this case, what we'd find out is the far right situation would create a decrease in value for the company. So this is going to be a pretty complicated set of slides, right? So we're going to talk a lot about different situations. Look forward to seeing you in the next video.